Welcome to the Hellenic Hour, and on the other line we have our regular guest, our financial advisor, Harry Petropoulos. Harry, thank you again for taking the time to talk to us.
Ross, thanks for having me.
Fantastic. Well, Harry, we touched on last week in regards to our youth, how they can put measures in place to save some money, to get into a habit, so they can, over a few years, to be able to obviously save a good deposit so they can purchase their first home or their first investment. So today we will talk about, why don't we talk about investments, the different type of investments that are available, and what your thoughts are.
Okay, so in terms of investments, I guess this is the real fun part after people have completed with their financial commitments. That's whether they've got a housing loan or a personal loan or credit cards. Once that's done and dusted, then people can look forward to investing their money. In my world, there's only three areas where you can invest your money. One is cash, the second one is property, and the third one is in shares. Now, obviously, each of those categories have their advantages and disadvantages.
Okay, well, give us the advantages.
Okay, so if we go to cash, a lot of people would say that's probably the safest asset class in the market. I would say it's probably the riskiest, and let me give you an idea why. If someone's saving money in their bank account, which is probably the best way to get started, if they just leave it in the bank account, really they're just earning interest, and that interest, depending on what the economy is doing, it may pay a high rate of interest or a low rate of interest. But we've seen that leaving money in the bank, we've often heard that term, your money in the bank is dead money. The reason why it's dead money is because there's no capital growth on your bank account. You're just receiving interest. So if I compared money in bank with money in the share market, if I took the years 1990 to the year 2010, if someone had invested $100,000 in their bank account for 20 consecutive years, after 20 years, their account balance would have grown to $305,000.
Right.
The same amount of money in the share market, that is $100,000 for 20 consecutive years, the value of their money would grow to $804,000. Why such a difference? Because the share market had the ability to give you growth and also give you some dividends. So a lot of people say money in the bank is safe. Yes, it is, but it's not going to give you any capital growth. So that's where we look at the two other asset classes of property and shares. And we can start off with property, as most people
Harry,
would see.
can I just cut in and say, well, I understood what you were saying, but just for our listeners' benefit, obviously, though, with the share market, there is also a risk involved as well. Would that be right?
Absolutely, yes. And every asset class has a risk. I guess if we look over the short term, people say to me that investing in the share market is gambling. Well, it's not gambling. It's simply another asset class that people need to understand how it operates. Now, with share markets, depending where you invest your money,
correct,
you can invest your money through the banks or through the resource companies. They can give you great capital growth and also give you some dividends, which is classed as income. So a lot of people who view the share market as gambling, that's not necessarily true. It's just another avenue of investing your money. I know, for instance, in the Greek community, the only asset class that they seem to be investing is in the property market, because for many years they've seen the property market being as the safest asset class out of all the asset classes that I've just mentioned. That's cash, property and shares.
Well, they always say that bricks and mortar is the safest investment, as they say.
Well, they do, and I guess there are figures to establish that point, because if we go back in the property market, whether it's 5 years or 10 years or 20 years or 50 years, it always seems to be one of the safest asset classes. In fact, in Australia, the property market has virtually doubled, anything from 7 to 10 years. So that's a pretty nice thing to have at the back of your mind, that property doubles every 7 to 10 years. On the flip side, if one was to choose their shares carefully, they could have the same result and perhaps even better.
I suppose, Harry, one of the things that I see quite clearly is that if you are going to invest in the share market, that you've got to have the knowledge, you've got to have the right experience, and of course, when you are purchasing a home, you're obviously, it's a safer. That's how people see it. It's a safer bet. If you don't know the stock market, it's best probably not to invest in the stock market, because
I totally agree.
There are many risks involved with that. Would you?
I totally agree. But hence, the property market, you still need to do the research as well. So anyone that's listening to this program, whether they decide to invest in the property market or in the share market, they need to do their research. Now, let me give an example about the property market. Yes, it's been a fantastic performer over the last 20, 30, 40, 50 years. On the flip side, though, property, if you bought a property 6 years ago on the Gold Coast or the Sunshine Coast or in Port Douglas, you've probably lost anything between 30 and 50% on the value of the home.
Yes.
So even in the property market, you're still required to do your research, so you know exactly what you're investing in. The share market is no different. I mean, Warren Buffett often says, if someone wants to invest in the share market, instead of trying to kill yourself trying to find which is the best share that you can pick, Warren Buffett often says, perhaps you should consider an index fund. Now, let me explain what an index fund is. So, for instance, if you wanted to invest in the banking sector, to pick one of our four big banks, that's Commonwealth, National, ANZ and Westpac. If you don't know which out of the four is going to outperform, then what you can do, you can go to the share market and say, I'd like to buy a piece of all the four banks. In that way, you're hedging your bet. So it's all about de-risking your investment and trying to maximize the outperformance of that investment. No, not too dissimilar from the property market. Yes, the residential market is seen as a safe asset class, but if we move to the property market and do our figures on the commercial property market or even in the industrial property market, the level of risk is a little bit higher, and therefore it comes back to your point that whatever you invest in, you need to do your research.
You need to have the knowledge, definitely. Harry, can I just ask, what should you be looking for when assessing an investment for our listeners? What would be your thoughts?
Yeah, very important. Probably the most important element is understanding yourself. So, for instance, if you were going to invest in the share market, before you approach a stockbroker or a financial planner and you're just getting started in the market, you have to ask yourself, if I'm going to invest in the share market, can I tolerate a loss for a small period of time or even a long period of time? Now, let me give you some spectacular returns that's happened in the share market the last 20 years, and let me give you some disasters. For instance, if you invested in a stock called Fortescue Metals, yes, the average return on that stock per annum is in excess of 12,500% per annum. I mean, that's really spectacular type of return.
Well, sorry, my ears. What was that again? 12.
If you invested in a stock called Fortescue Metals,
yes,
the average returns from inception has been in excess of 12,500% per annum.
Wow, I thought I heard right the first time, Harry.
Now that is spectacular returns, and it'd be great if we can all get it onto a stock like that, but that's like 1 in a million. On the flip side, people that invested in the stock market 6 and 7 years ago, like another stock called ABC Learning Centres, that went virtually from $2 right up to the moon. It went to $10, $11 and $12,
and then
a couple of years ago, it went broke.
Broke, definitely, yes.
So you have to understand your risk profile. I'm not saying that people should invest in ABC or invest in Fortescue Metals. All I'm saying is that there are opportunities in the stock market where people can achieve some capital growth and receive some great income as well. And the difference between income from the stock market as opposed to the property market. Let me give you the difference, because this is really important for our listeners.
Yes.
So if someone invested in the property market, now we're receiving a rent, with the rent achievable on a per annum basis, you have to pay your expenses, you have to pay your rates, and you have to pay your water, and you have to pay your insurance, and you have to pay your land tax. So when people go out and achieve a rent on their investment property, the rent that they receive, it's not actually the net amount. So someone said to me, I'm achieving a 5% return on my investment property. If you were to take and deduct all the expenses, that's